While everyone's chasing the big names like Nvidia with their trillion-dollar valuation, there's an AI chipmaker trading at just 8 times earnings that's stealing market share in the exact segment where AI is actually scaling right now. Most retail investors never find this stock. They see Nvidia pumping, they buy Nvidia at 35 times forward earnings, and then they wonder why their returns are mediocre. In this video, you're getting 3 things. First, the exact scorecard framework used to rank every major AI chip stock objectively. Second, the specific catalysts that make right now an unusual entry window. And third, the honest risk picture, because blind optimism isn't a strategy. I'll also reveal why the smartest money in semiconductors is quietly rotating away from the most obvious name. And where it's going instead. Let's start with the big picture. AI chips are the pickaxes of this gold rush. It doesn't matter whether OpenAI, Google DeepMind, or some startup nobody's heard of wins the model wars. The company manufacturing the silicon underneath all of it gets paid either way. That's what makes chip makers structurally more durable than pure-play AI software bets. Software valuations collapse when the narrative shifts. Hardware demand compounds as inference workloads keep growing. But not all AI chip stocks are created equal. Coming up, we'll show you exactly what separates the winners from the hype. To find the top stock, every major AI chip player was scored across 5 criteria. Revenue growth rate, gross margin trajectory, customer concentration risk, total addressable market, and current valuation relative to forward earnings. Think of it as a disciplined filter. It removes emotion, removes brand recognition bias, and keeps only the numbers. AMD scores well on TAM but carries margin pressure. Qualcomm's Edge AI story is real but growth is uneven. Marvell Technology is interesting but customer concentration is a legitimate concern. Intel is a restructuring story, possible upside, but too much execution risk right now. One stock scored at the top in 4 out of 5 categories. And its name might genuinely surprise you. Quick note, if you find this useful, subscribing takes 2 seconds and it genuinely helps me keep making these. Now, back to the stock. The company is Broadcom. Ticker AVGO. Not a household name for most retail investors. But the hyperscalers Google, Meta, ByteDance, they're paying Broadcom billions to design custom AI accelerator chips called XPUs, specifically built for their inference workloads. These aren't one-off orders. They're long-term supply agreements. And Broadcom is doubling its advanced packaging capacity heading into 2026 to meet demand it's already contracted. That's not speculation. That's backlog. Here's something wild, Broadcom's AI revenue grew over 220% year-over-year in its most recent fiscal year. That's not a typo. And it still trades at a significant discount to Nvidia on a forward earnings basis. Strong fundamentals are only half the story. Next, we break down the exact price levels and catalysts that make right now the optimal entry point. 3 catalysts are converging. First, Broadcom's next-generation 3nm XPU is expected to enter volume production in late 2025. Historically, that triggers a re-rating in semiconductor stocks. Second, analyst coverage has been expanding. Several major firms initiated or upgraded VGO positions in the past 2 quarters. Third, and this is the one most people miss, Broadcom is a strong candidate for increased index weighting as AI infrastructure spending becomes a larger share of S&P 500 earnings. Index inclusion or weighting changes force passive funds to buy. That's mechanical demand that has nothing to do with sentiment. Here's something most people don't realize about passive investing. Index funds don't choose stocks. They're required to buy them. When a stock's weighting increases, billions of dollars move automatically. Whether fund managers like the valuation or not. That forced buying is already baked into the math for VGO. Before you buy, the risks are real and you should know them. Customer concentration is the primary one. Google alone represents a substantial portion of Broadcom's custom silicon revenue. If Google pivots its chip strategy internally, that's a revenue hit. The second risk is geopolitical. Export controls on advanced semiconductors to China have already impacted the sector and could tighten further. The hedge on concentration risk is position sizing. Keep a VGO as a core holding, not a concentrated bet. The hedge on geopolitical risk is a predefined stop-loss level so one regulatory headline doesn't wipe out your gains. On a 12-month forward earnings basis at a conservative multiple, a VGO still offers over 40% upside from current levels. Here's what to take away. AI chipmakers are infrastructure. They win regardless of which application dominates. Use a 5-factor scorecard to compare stocks objectively instead of chasing brand recognition. Broadcom has secured hyperscaler contracts and is expanding capacity. Those are two signals historically correlated with sustained revenue growth. Watch the 3 catalysts: XPU product launch, analyst coverage, index weighting as confirmation signals. And always size positions with geopolitical export risk in mind. If this video saved you time or gave you a real edge, subscribe. I post every week and the next video covers how to build a complete AI infrastructure portfolio beyond just chip stocks. Drop a comment below. Are you already holding a VGO, or is this the first time you've looked at it seriously?